Guys, stocks just hit all-time highs, and this is the exact moment that people start making the biggest mistake with their money. Not when the market crashes, but right here at the very top. So as an investor, you need to be aware of everything that I'm going to talk about in this video. Now, let's start with what actually just took place in the stock market. The S&P 500 just closed above 7,100 points for the first time ever. The NASDAQ, which is tech heavy, just logged its 13th straight winning day. The Dow Jones also jumped over 850 points in a single session. And even small caps, right? The Russell 2000 index surged right along with everything else that was going up. So this is across the board. It's not isolated, okay? This is the whole market basically bouncing back big, right? It's momentum. It's confidence. And when you see all-time highs, just like the thumbnail to this video said, most investors immediately go into what? Reaction mode. And they get excited and they get hyped up. But I'm here to tell you something. Before you react, we need to understand what this moment actually represents right now, because this is where people misunderstand the stock market. When prices are falling, people do what? They get cautious and nervous. But when prices start going up, like we're seeing right now, people get hyped up. And that's where people stop following their system and they start following these feelings of excitement. And I want you to taper that down just a little bit, right? A lot of people right now are going to start asking questions that really don't matter if you're a long-term investor. The types of questions people are asking when everything goes up like we're seeing is this the top? Can it go higher? Is it going to go higher sooner rather than later? Should I wait? What did I miss? Did I miss anything? Those questions are responsible for destroying more wealth than almost anything else. So let's address the real elephant in the room when you see everything going up like this. The biggest mistake investors make, regular investors like me and you, are the mistakes that we make when the market hits these highs. We try to time the market, right? Regular investors start to think that they're being smart. They're going to get in and then they're going to get back out. They think they're being patient, right? We're going to wait, we're going to jump it. But what they're actually doing by trying to time the market is stepping out of a system that's already working or has already worked. Because here's the reality. You don't know when the top of the stock market is happening. You don't even know when the pullback is coming. And you definitely don't know when the recovery is going to start. And that last part is where the damage usually happens if we're not careful and we're not following the system. So you want to be aware of this, okay? This isn't theory. It's not my opinion. This is documented with studies that we ought not be trying to time the stock market. JP Morgan and Morningstar and maybe even Fidelity, I believe, have all run long-term studies basically indicating that you should not try to time the stock market. And they consistently, all the studies show the same thing. If you miss the top 10 best days in the stock market over a 20-year period, your returns can be dramatically reduced and sometimes cut in half. That's half, okay? And here's the part that experienced investors understand, but most people don't. The best days in the stock market don't always happen during the calm markets. When everything is going along very smooth or everything is on the way up, that's not when the best days happen. The best days in the stock market oftentimes happens during chaos and when the market is down. See, most of the best days occur within just a couple of weeks of the worst days, which means if you try to time the stock market and you step out of the market, you can almost guarantee that you're going to miss the big old rebound that's coming and you're going to miss those best days. And that's what kills long-term portfolio performance if you're not careful and you're trying to time the market. Now, why do people still try to time the market? I mean, logically, it actually makes sense, right? But the problem is that the numbers and the data show different. They show that it doesn't work. So why do people still do it? Because investing, here's the deal. Investing is not just math. If it was math, it'd be simple and we could figure this thing out with no problem. Investing, stock market investing, is really psychology. Fear causes people to sell their stocks when the market drops. Greed is what causes people to chase after the next hot stock or chase after the stock market when everything's going up. And hindsight, right? Hindsight is always 20/20. It makes every move look obvious after the fact, right? And so people convince themselves. They say, I'll just step out of the market right now. And I'll step back in the market when things look a little different. I feel a little better about it. But that requires being right 2 times. You got to know when the right time to exit, and you got to know when's the right time to get back in the market. Listen to me closely. You're not that good. I'm not that good. In fact, nobody's that good, because even professionals who've been doing this thing for 40 and 50 years, or before any of us were born, they all struggle to get it right consistently. So if timing doesn't work, what does? This is where we have to shift our regular investing minds from reacting to the market in an emotional way to strategy. This is where dollar cost averaging comes into play for most of us, right? Not because dollar cost averaging is exciting. It's not. But because it removes the decision making, and it removes the need for us to be right twice, right? Dollar cost averaging is just this. It's where you invest a fixed dollar amount at regular intervals, regardless of whether the stock market is up or the stock market is down, or your individual ETF or index fund or your individual stock is up or down. Doesn't matter. None of that matters. Dollar cost averaging just means you just keep investing. $100 a week, $300 a paycheck, $200 a month. You just stay consistent and keep doing what you do. Keep showing up. And what happens with dollar cost averaging is this. Over time, you buy more shares when prices are down, and you buy fewer shares when the prices go up. But what happens is you're averaging out your cost basis the whole time. That's all dollar cost averaging means. That's not theory. That's how real solid portfolios are built over decades. Guys, if you're getting any value at all from this video, do me a favor, please, and drop a comment below and let me know what you think about this stock market hitting all-time highs. And share this video with your network of good people. Now, let's get back to the video. Now, let's take what we're seeing in the market a step further, okay? Because there's something else happening right now that you need to be aware of and understand. Stagflation, right? Right now, the risk of stagflation is really going up. Right? Quietly. Stagflation is this. It's a combination of pretty much 3 things. A slowing of the economic growth, the GDP, and we saw a slowdown in the GDP in the last quarter of 2025, right? And we're also seeing a slower economy right now. Second thing that is required when we're talking about stagflation is persistent inflation that won't go down, which we just saw a couple of weeks ago that the year-over-year headline inflation rose to 3.3%. And even the core CPI inflation rose a little bit also. And part of that is obviously because of what's going on in the geopolitical space, right? Over in the Middle East. Now, the third thing that stagflation requires is weakening employment conditions. Again, we're starting to see all 3 of those. Just a little bit, right? All these things create pressure across the whole economy when we see stagflation. And historically, that's one of the hardest environments for all of us as Americans to navigate when all those 3 things are happening at once. So here's the question. If the economy is under this pressure, why are stocks at all-time highs? And this is where most people sort of have a disconnect in our brains, right? Because here's the deal. The stock market is not pricing in what's happening today, right now. The stock market is pricing in expectations for the future. Now listen, if you don't take anything else from this video, please understand this. The stock market is comprised of businesses. All businesses on the planet are always looking forward, right? Which is why businesses stay in business, because they got to predict and project what's coming. So businesses are reacting to what they think and perceive the future is going to be. A business is looking a quarter or 2 quarters or 1 to 3 years or 5 years out down the road. So when you see businesses tightening their belts, it's because they see something coming. Right now, corporate earnings are still strong for many companies that are publicly traded. AI is driving tons of investment and optimism throughout a lot of different sectors in our economy. And large cap companies, the big boys, right, are still producing lots of growth. So the stock market, which again is just businesses, is choosing to focus on right now earning strength, future productivity down the road, capital flows that they see on the near horizon out there, right? They're looking forward. So as they look forward, they make moves within their company that look like growth. And what companies are doing right now is they are temporarily ignoring what we are actually seeing in the data today. We're seeing higher inflation. We're seeing slower economic growth, and we're seeing geopolitical risk, right? All throughout the world. So that creates sort of a conundrum for us, right? The irony. And that's why this moment right now is dangerous for undisciplined investors. So we have to be disciplined, and we have to invest with a strategy, not just invest with our emotions. So what do we do in an environment like this? Don't panic, right? But you also don't ignore what we see happening. You want to be aware and you want to adjust if necessary in terms of your own portfolio. But you don't get emotional and hyped up just because the stock market's at an all-time high. So here's some moves to think about as a regular investor. First, stay consistent with dollar cost averaging. Don't stop. You don't have to invest more, invest less, or try to time the market. Just keep going. Steady wins the race. Second, increase your exposure to defensive sectors. This could be single stocks or ETFs or index funds, whatever you decide to invest in. What are defensive sectors? Consumer staples, right? The things that you always need no matter what's happening in the economy, right? So think about some of those companies or ETFs or index funds that are consumer staples. Healthcare, utilities, right? Energy. These are sectors of the market that usually hold up better when we have a slower growing economy, okay? Third thing is this. If you like, you can shift some of your allocation of your stocks and future investments towards dividend paying assets, right? Because cash flow matters in uncertain environments. Another thing you can do, fourth thing you can do, is consider real assets instead of just paper assets. What are real assets? Commodities, gold, silver, or even real estate. All of these tend to sort of hedge against inflation. The fifth thing you can do is make sure you have some liquidity in your life. What is liquidity? Money, cash, emergency money. See, cash gives you flexibility without forcing you into bad decisions. Now listen, I'm not saying go out and hold a whole ton of cash. You 35 years old and you want to hold $200,000 in cash. No, I'm not saying that. I'm just saying make sure you have enough cash to cover you as a safety net, right? Emergency fund, at least. It's always a good idea to have that. And finally, think about rebalancing your portfolio. Oftentimes we don't think about this often, but rebalancing your portfolio to match whatever your strategy is, right? Maybe it's 20% here and 40% here and another 40% there. Well, maybe you need to rebalance every now and then, making sure that you're not overexposed to any high growth sectors like tech or sectors that may face pressures coming up, right? These are things that you can do to sort of prepare and protect yourself and think about even when the market's high and everybody's hyped up. Slow down, revisit your strategy and your core investing philosophy. This is exactly why the title of this video matters. Stocks just hit record highs. Yay! But us as investors, we need to be aware of how to interpret this information. The warning is not about the market may crash. That's not the warning. The warning is about how you respond right here during an all-time high in the stock market. Because the biggest mistake that investors make is not during the downturns necessarily. Usually, oftentimes, it's during the strongest markets when people sort of get so hyped up and so happy that they abandon their strategy. It's when everything looks good. People tend to stop being as disciplined as they should be, and they forget about structure. Look, you don't build wealth by reacting to the stock market emotionally. You build wealth by sticking to a system, no matter what the market's doing. Listen, I hope this helped you understand things you need to be aware of, even though we see the stock market hitting all-time highs. If you got value from this video, I would really appreciate it if you drop me a comment below. And also, please share this video with someone who you know in your circle of good people. Listen, the best person who's going to take care of the old you is the young you. Until the next video, peace.